Hey guys and girls, welcome to another video. We're going to be looking at some macroeconomics and central bank policy, and everyone's been talking about the Fed, what they're going to be doing. Everyone's talking about the geopolitical situation, the war, supply constraints, supply chains that are broken, yada yada yada. I just want to try and see if I can kind of summarize a lot of what's going on and some of my interpretations of what's likely to happen or what the risks are going forward, and how central banks are going to handle this and how markets are possibly going to react to that. So, basically talking about the position central banks have gotten themselves into, how their actions can influence the markets, and how the world around us is actually currently influencing their actions, which is kind of creating this immense challenge. And then, what that means for the state of the economy and investors, traders, and everyday people alike. So it's going to be challenging. I'm going to try and record this in just one piece. So, bear with me. Note that this is not per se actionable intel on a day-to-day basis. Markets will forge, their own path through liquidity and positioning on a day-to-day basis. But what I'm trying to aim for here is to paint the environment, whether the environment is going to be accommodative for risk assets and other kinds of assets until we see a policy pivot, or that we should not worry too much. And then, before I dive into things further, I think it's good to note that before I introduce the sponsor of this video, is that I may have or may not have at points butchered concepts. I think I don't. But I could have, and remember that the information I share relates to my opinion and interpretation of the information around me, and that nothing I say is meant as advice in any way, shape, or form, be it financial, legal, fiscal, etc., or any other kind. So I'm just going to be blabbering a little bit, and then a little bit more, and a lot more. Hopefully, I can make some sense of what's going on. Hopefully it's going to help you to kind of create your view on the market. And I'm going to try my best to convey a few concepts here. So let's start with getting the sponsor some attention. PrimeXBT, the exchange that's sponsoring this content. You can trade all kinds of stuff there: crypto, gold, equities. And if you sign up with the ref link in the description and use the promo code BitcoinJack, you will get up to 0.25 BTC deposit bonus. Consider, if you like my content, to register and deposit. It really helps out here. It helps them out. It helps me out, and keeps me going on these videos. So appreciate you, PrimeXBT, for sponsoring. And we're gonna start. So I think what I want to do here is first kind of have this overview of how we got here, what's happened, a little bit of history. If we go back all the way to the 80s, we have this blue line here, and that's the Federal Reserve funds rate, which is the interest rate that banks charge each other and the central bank charge to borrow money or to lend money. Right, and you can see here back in the 80s, early 80s, that was almost 20%. So you would get banks would charge each other, and obviously that is what people are getting charged in the real world, 20% on a loan. It's a lot. And then over time, that number came down a lot, all the way to zero. It first hit zero in 2008 after the financial crash. And it's come up a little bit in 2018, 2016, 17. And then as COVID hit, we went back down to zero. So what does that mean? Well, it means that markets have been extremely financialized because money was earning less and less yield. So that means that people would go outwards on the curve, fixed income bubbles, as we could call it, where you just deposit, I don't know, $1 million and you're just earning 10% a year for like 10 years. That was, you know, a lot of easy money with very low risk, and obviously that became a very crowded trade, and rates eventually became zero, and that meant that a lot of that money that initially was investing in fixed income, in loans, whatever, started to go into equities, and so you see this goes down. Obviously, this is not like 100% correlation, but I think there is causation, and then the equity market just, you know, did this. So what else do we have in this chart? So the yellow line here is the Fed balance sheet, which is the amount of assets that the Central Bank of America owns. And then we have the M2 money stock in purple. You see that's just going up. So we see that over time a lot of money has been printed, and on a linear scale it's just going parabolic, which, you know, it's logical if you have, like, for example, on average 2% inflation every year, and you print a little bit more than that every year. That's going to be a parabolic curve. So, you know, rates have been practically zero, and then accounted for inflation, they've been negative for a while. Rates at zero or close to zero, and then you had inflation like 2-3. At the moment, a lot more percent. That kind of created this entire push here. And in 2008, after the financial crisis, the central bank started to apply, I think they call it unconventional monetary policy, where they just started injecting a lot of liquidity into the market by buying things off the market. We call that QE. A lot of you probably already know that, but I just wanted to mention, just, you know, to make sure that everyone who's new here also kind of is able to follow the story. And let's see. I think I'm almost done. Yeah. So this started to go up, and then in 2012 we had Powell, who was already part of the board of the Federal Reserve but not chair yet, talked about, you know, going forward what they had to do with the market and what that would mean for the market. And I think we can look at that here. Oh shit. All right, I need to get to the right page here. It's reloaded. I think it's page talking selling. Oh shit, this is so stupid. Okay, well, there's only 5 occurrences of this. All right, here we go. So basically, the challenge that the Central Bank of America has, the Federal Reserve, is that they've been taking on all this debt on the balance sheet, right? So right now there's around 9 trillion in assets on their balance sheet, and they kind of have to run it down. And the other thing that's happening right now is that we have inflation. So what they've been doing for the last couple of years, since 2008, they've been injecting a lot of money into the market to keep markets afloat, to reassure investors that the market was going to be easy. And the Federal Reserve has the mandate to keep prices stable. Stable prices means that if inflation goes up, then we have to slow down the market and bring those prices down. Otherwise, people who have a certain amount of disposable income will lose disposable income, and eventually the market is just going to get too expensive for them. And that means that we spend less, the economy slows down. So eventually, inflation is bad for the economy. So we need to stimulate wages, but not too much, while taking out the inflation. So that's kind of the challenge that the Fed has themselves into. And now I'm gonna show you this chart first, and then we're gonna go to what Powell said in 2012. But this is the Fed balance sheet divided by the money supply in America. And the first thing that we can note is that the balance sheet growth has outpaced printing. Basically, the fact that this is higher here than it was here means that the rate at which the balance sheet grew has been faster than the rate of printing. And what the Fed wants to go and do now, as they've been signaling for a couple of months, is they want to aggressively raise rates while starting to reduce the balance sheet, which is 9 trillion, at a pace that may be well within the 1 trillion per year range, into what seems to be shaping up as a recession. I believe that the GDP growth for the first quarter of this year was minus 1.4%. And they want to do this in a way where they try to get a soft landing. So not crash markets too hard, but just, make them calm down. And Powell made a remark in 2012, which basically says that he knew back then that it's impossible. And the situation back then was a lot different, because the situation back then was, he was talking about it here, 2012, and the balance sheet grew to 4 trillion, 4.5 actually, but now it's like double, it's 9, right? And so we're going to be looking at that in a little bit. And as they started to do that back in 2018 here, he decided to revert and decided that it was bad for markets, and they just kept on printing. So what did he say? Well, he said, I have concerns about more purchases. The first question is, why would they stop at 4 trillion? The obvious answer was that, it would probably not add a lot more economic growth to the market. But here's the juicy part. He said, I think we're at the point of encouraging risk taking. Investors really do understand now that we will be there to prevent serious losses. It's not that easy for them to make money, but they have every incentive to take more risk, and they are doing so. Meanwhile, we look like we are blowing a fixed income duration bubble right across the credit spectrum that will result in big losses when rates come up down the road. That's what they're doing right now, raising the rates. And then he said, you can almost say that this is our strategy. So basically what they have been doing is trying to pop the fixed income bubble, so this entire curve. And then at some point, the rates had to come up, which already started happening in 15, 16, all the way to 2018. And he said that they were going to try and, break the markets. But then he pivoted later on, and I don't know whether that's because he took office here, and then decided, holy shit, like I'm in charge here, or the market is so fragile, or I want to have a good score, or I don't know. And then the other thing he said, my third concern is exiting from a near 4 trillion balance sheet. Back in 2012, he thought that the balance sheet would grow to 4 trillion. It grew to 4.5 trillion into 2014. And he realized that that was going to be a very challenging thing. He said, I think there's a pretty good chance that you could have quite a dynamic response in the market when you're starting to sell those assets on the sheet. So he did say here and then here that doing this was going to be catastrophic, and then he wanted to get rid of about $1 trillion of the balance sheet, and he ended up only doing like $500 billion, and then completely ran back on his own words from 2012. So I don't know if this time is different, but the big difference is that back in 2018, there was a lot less inflation, and now they have a lot of inflation. So we're going to just jump to this chart, which, no, wait. Yeah, so here's a little picture of something that indicates a little bit of inflation in the 5-year time horizon. This kind of says that the market is expecting an average of 3.2% inflation over the next 5 years, steady. So, that could be 7% this year, and another one next year, and then it may come down. But as you can see, compared to, for example, 2018, which is here, and 2008 is there, we're a lot higher. So the Fed has to somehow reduce that inflation. That's the challenge here. And they can do so by stopping buying assets from the market, which injects liquidity into the market, which drives prices up. So they already stopped doing QE. And then the other thing they can do is QT, which is selling assets from the balance sheet. That is essentially what they're doing. And then the other thing they're going to be doing is raising the rates, which makes cost of borrowing higher. We're going to be talking about this and going to try and explain that. But that's, what's happening here. And it's the inverse of what we have been seeing, at least for the last, 13 years, but really it's the inverse of what's been happening since the 80s. So they've blew up the fixed income bubble, and now rates are going to come up. And as Powell mentioned in 2012, doing that with an iron fist is going to have quite a dynamic response in the market. Here is a little picture of all the deposits on the balance sheet of FDIC insured commercial banks and saving institutions multiplied by the 10-year yield. So basically, this is what's on balance. And if there's any debt, like let's assume over time, the amount of debt here is equal. So the amount of leverage is equal. Higher interest rates gonna make it more costly to service any of that debt. So over the years, lower rates have been able to allow institutions and banks and governments to refinance previous debt at lower rates, which made their cost to service that debt lower. It's not going to be possible anymore once you start hiking rates above levels that we haven't seen in a long time. So let's say the 10-year yield is going to go to 4%. It's going to create a lot of trouble. And I don't know if this is the correct interpretation, but this kind of describes to me, it kind of is a proxy for credit risk. And as you can see, it was pretty high back in, at the top in 2018 when we had the financial crisis, liquidity crisis, and it peaked pretty high in 2018 when the Fed started to kind of try and deflate the markets a little bit, and then there was a giant overreaction, which pushed us into here when the Fed pivoted back on their policy. But now it's at absolute bonkers levels. So if this does resemble some kind of credit risk, there's a lot of credit risk. Inflation. Ooh. Okay, so this is another picture just for to show you prices. What the Fed can do is they can inject liquidity into the market, and they can take liquidity out of the market. If they raise rates, if they reduce the balance sheet, that's generally going to reduce liquidity in the market. And when they do QE and when they buy assets from the market, like bonds or whatever, they inject liquidity. And markets generally thrive on liquidity. If there's a lot of liquidity, participants are willing to take risk, and volatility is down. So basically, you're just going to trend up, and maybe you're going to see some corrections, but generally it's just going to be a fairly straight line. And low volatility environments, generally with high liquidity, they just don't generally trend up. Once that reverts, when you have low liquidity, market participants become a little bit worried, and they pull more liquidity. And then when there's not a lot of liquidity, you're going to have a lot of volatility, which is a vicious cycle to the downside. I think I talked about that in my tweets in February and March. Maybe we can take a look at them later. But as you can see, the other thing they cannot do, the Fed or central banks in general, is conjure real world items. They can conjure money as a number in the bank and spread that to other banks and people who require liquidity. But the other thing they cannot do is they cannot conjure weed, they cannot conjure natural gas, they cannot conjure oil, any other type of commodity. And when those go into a shortage, whether it's because of a supply chain issue or any other issue, that's going to drive inflation. And it's something the Fed cannot really fix. If you have a stable economy, you can fix that over time. It's going to take time, right? If you have a stable economy, stable geopolitical situation, you can go into building, optimizing supply chains, and that is, not the case right now. These charts are pretty ridiculous, and the Fed is out of control when it comes to inflation on these products, and these products are priced high because we have a war going on in Ukraine. So, the fifth largest wheat producer in the world is being burned to the ground by the Russians. The Russians themselves are, like, I believe one of the largest wheat producers in the world. They're like, not as likely to be as friendly to unfriendlies to export certain products. Europe is trying to get rid of the dependency of natural gas and oil. We're going to have this embargo going forward. So everything is getting more expensive, and it's out of the Fed's control. So I need to, all right. And this is going to be what we already talked about, but I would say a bunch of slides here. But why is inflation bad? Well, if you let inflation go rampant, disposable income diminishes, which slows demand, and currently rates are at 0. And if we just assume that, if the goal is to reduce inflation, lowering rates is not a possibility, and going negative is just gonna cause a lot of trouble. You know, it's gonna cause inflation to go rampant. So essentially, when markets break, the Fed at this moment has very few tools to induce liquidity in the market, like to support the market. So they wanted to raise their rates. The alternative, you know, to letting inflation go rampant is to hike rates, which will suck out liquidity out of the market. Labor markets eventually just become unhinged if the economy breaks down too much. But all that contributes to slowing down the economy, which slows down demand. And at the same time, they would have tools again, the Fed, that is, to support markets if something breaks. So let's say they raise rates from 0 to 3%, something breaks in the market, and then they can intervene, create a bottom to at least support the market. Question is whether market is their main concern. The main concern is inflation, and markets have been, let's say, expensive, overvalued, which creates a wealth effect. A lot of people have a lot more money than they had, which A, makes them contribute less to the labor market, and B, makes them spend because they think they're rich. So the other thing that we talked about is the Fed's job is relatively easy when you're operating in a vacuum. But when it comes to the real world, supply chains and constraints, which we're seeing live happening in front of our eyes last couple of months, there's limits to what they can do. And, you know, they're going to be fighting inflation. That's at least what they're saying. So let's assume they will, and they will do it hard. So what they want to do is decrease the spending, circulating money, decrease demand. They want to try and increase supply of goods, but they really, can't. There's a wealth effect for everyone who owns a house, stocks, Bitcoin, everything in that direction, which is something they could be targeting. And the other things they can do is create higher costs of borrowing. If it's more expensive to borrow money, people are less likely to borrow money. There's going to be less money circulating. Yeah, I mean, we have, what can they do? They can higher cost of borrowing, lower asset prices, lower employment rate, and or decrease wealth effect. And this is particularly interesting. A lower employment rate ideally is not what they're trying to achieve. I think they want to try and achieve a good employment rate where people actually still get to make money. Otherwise, they get hurt by the inflation too much. But at the same time, lower the wealth effect. So good employment, decreased wealth effect. That's, if they want to have a soft landing, that's what they're going to try and do. Because that's going to hurt the least people. Whilst taming that inflation. And then, we talked about this. How do they achieve increased supply? Well, they can't conjure oil or gas. They can conjure liquidity. They can go brrr, but that's going to go against their mandate. And then a strong economy and geopolitical stability. Well, obviously, that's not what we have. Optimized supply chains are not what they are anymore. And I think optimized supply chains are going to be tricky to reinstate. It's probably going to take a while, but there's a lot of things that we don't know going forward. So there we go. And then there's, you could unleash a lot of thought process on motivations present to tighten markets, aside from, obviously, inflation and other kinds of stuff. A strong dollar. Sorry, Need to do a little burp. A strong dollar means cheaper imports, so that kind of lowers the effect of inflation for the US economy, as long as, they get to import stuff. And the other thing is, we're talking about kind of a war. It is like you have China, Taiwan, which, it could become a conflict. Obviously, the US is opposing China, and, well, I don't know if they're opposing China, but if China wants Taiwan, obviously they're gonna oppose them, and then they oppose Russia. So that's, that creates the West versus the East, or however you want to call it. But a weak dollar is going to push people away from saving in dollars, pushes away allies, which decreases the US position. And the other thing, you could think of, and maybe there's more points to the reasoning here, but these are the ones that I came up with, is that in the face of geopolitical instability and possible war escalation, out of control inflation is, it could trigger domestic instability, which is this point here. So yeah, there's reasons to be aggressive about raising the rates and tightening, and they're going to try their best to do it in a way where the economy stays functioning, though it's, we're looking to already sliding into a recession. What's causing inflation? Well, obviously, the unprecedented wave of liquidity injected post-COVID crash, and all the other liquidity injected the balance sheet that, is attributed to what they call unconventional monetary policy that started in 2008. And we kind of crossed these already. 40 years of lowering cost of money. So essentially, this fixed income bubble that came down, it just became a lot cheaper to get your hands on money / liquidity. And the housing market, which creates anyone who has a house is a lot richer now. Anyone who rents out a house is a lot richer now. There's been, less labor participation, so you create less goods, but there's still a lot of money floating around. So when you have less goods and you have more money flowing around, prices go up, Negative real yields, we talked about that as well, is just the fact that, if you account for the interest rates you would get on lending money, you would lose because, let's say I got 0.5% from you, and then inflation is 3%, then I lose purchasing power over time. There's supply side constraints due to broken supply chains. We had COVID, China lockdowns, Euro lockdowns, but also the Ukraine war. There's people hoarding in the face of shortages. Like, for example, today I think there was news coming out of India. They're not a large wheat producer, but what they do need wheat, and their this year their yield is going to be shit. I think they, so they're thinking about banning export. Indonesia is banning export on palm oil. Prices jumped 10%. So there's a lot of things going on. Oh yeah, so oil embargoes, I think, like sanction around 6 of the European Union now mentioned to restrict or limit the purchases of Russian oil. And then there's a lot of people like, okay, well, we have enough oil. Yes, we have enough oil, but it needs to come from somewhere else. And when you replace a supply chain that was chosen for a long time, it was chosen because it was the cheapest. So we, on the west side, we get to share the same amount of oil or no, less oil with the same amount of people, and moving it from A to B is going to be more expensive. So what happens? Prices go up. This is all outside of central bank policy power. And then we could keep on going, but the list is pretty insanely long. What are the other factors creating pressure on FX and liquidity? So let's, for example, take Japan. So on one side of the world, we have America, which is tightening, going to do balance sheet runoff, raising rates, and that made for a very strong dollar. The dollar has, I think the dollar index is up like 15% in the last year, which is quite insane. Let's look at Japan. Japan is a strange place. So the Bank of Japan is buying unlimited amount of bonds at 0.25%. This is causing insane inflation and devaluation of their currency, which is one of the drivers behind the rise in dollars. And, that's upsetting FX markets, people who need to reposition. It's upsetting in so many different ways that it's hard to understand where things break. But if they keep on doing this, inflation in Japan will just get out of control. If they stop doing it, there's so much debt that needs to be resurfaced that cannot be resurfaced, or it can be resurfaced, but it's going to be a lot more expensive because yields go up. And I don't know if you know, but Japan is the world's second largest developed economy, like ranking third in GDP. I think it ranks first worldwide in terms of debt as percentage of GDP. And what they're doing here is, it's just increasing debt like a maniac. So is Japan going to break at some point? I mean, it's possible. But that's going to knock over a bunch of supply chains as well. That's going to knock over stupid things, okay? And they're not the only one. China is still injecting liquidity to kind of save their market. European Union doesn't really know what it's doing. It's still loose, but it could go tight. But that creates tension on foreign exchange markets, and that eventually could translate to tension on credit markets. And, like if you think about supply chains, if you need to change routes or, source your commodities from a different place, it's likely going to be a longer route, which is going to require more credit because the longer a boat is going to be on its way, the more fuel it's going to use, the more time it's going to take. So, whoever is financing the credit is going to see a little bit more risk to get stuff from A to B, so charge higher interest rates, etc., etc. And, broken routes cause for losses, and that also makes credit more expensive. And then it sounds kind of silly, but in the end, when it comes to those supply chains being, replaced or broken or delayed or longer, prices go up or supplies dries up and prices go up. Anyways, there is a shortage of supplies and it cannot be fixed by federal banks. This is geopolitical. If everyone in the world comes together tomorrow and say, hey guys, let's have peace, let's put back into place those highly optimized supply chains, great story. And then we go back on everything that we said until now. And all this kind of leads to that uncertainty, volatility, leads to lack of participation and liquidity, raising rates, QT, like tightening, reduces liquidity. So we're getting into a situation with incredibly low participation in liquidity, and those rates have yet to come up. Like, we're at 0.25% more or less right now with the Fed funds rate. And, we might go up to 0.75 today. So at another 50 basis points. Maybe it's going to be 25 basis points. Maybe it's going to be 75 basis points. But what we do know is that they're going to go up, those rates. And the market is expecting, we're going to be looking at that later, but I think, around 3.3% next year, September next year. All right, let's see if I can get us to quote unquote the next slide. And obviously, okay, so there's a lot of unknowns in this story. Going forward, how long will the war last? Will the war escalate beyond current scope? Do we exactly know what central bank policies will do? I mean, going back here, Powell said they were gonna, wreck the markets and run off like 1 trillion and raise rates, etc., etc., and then they just ran back on it, right? They didn't really do it. So could that happen? Absolutely. So that's a large unknown. And then the other unknown is like, how big is the avalanche when things break? This particular point here, that's one that puts further pressure on supply chains. And if this happens, also puts more pressure on supply chains because, economy breaks and shit goes bankrupt. And then people lose jobs, and it's just, the idea of it doesn't have to happen, but it could happen. And then the idea of it is pretty sick. And then, on the subject of central bank policy, since the 80s, cost of labor went down significantly, and I think there was a transition of that energy, to say so, into capital markets. And there's a few proponents that think central bank policy, could try and favor to stimulate slow wage growth, which in itself wouldn't really slow down inflation much, but focusing on reducing the wealth effect of, lowering stock prices, asset prices, housing, raising retirement age, and that should, aid to higher labor participation, whilst keeping a functioning economy, and at the same time, hopefully, slow down inflation. All whilst people get to spend their money and take care of their minimum needs. So next kind of slide, just to keep me in a little bit of a rhythm and flow here. 40 years of lower interest rates, financialized markets. Yeah, we talked about that. The trend has been broken. So that's, something that we can easily visualize. We can take the 10-year treasury yield. So this is the interest rate on the 10-year bond. And I don't know how you want to draw it. You can draw it in so many different ways, but essentially here, it seems that we're my bad. I kind of prepared all this stuff and then I forgot to prepare a bunch of shit. But this is this is, let me just draw it like that. Obviously there's quote unquote resistance. I don't know. People trade this shit. Well, markets indirectly trade this shit. But this is, this is so far a full reversal. I think if the Fed is serious, this is gonna get up into at least a 425 range. So basically the low from 2000. And that's gonna be brutal. So yeah, what happens when you raise interest rates and start hiking whilst reducing balance sheet and no asset buying? That's something you gotta ask yourself. Markets have been able to refinance their debt at lower rates. We talked about that. And as rates come up, it's gonna be trickier and trickier and harder to actually refinance that debt. So cost of servicing the giant pile of debt that we have in the world is getting more complicated, more expensive, yada yada yada. So like is Fed policy forward guidance priced in? I don't know. Some of it definitely is. Like we started doing QE. Stopping QE, and when we stopped QE, markets started to slow down, sideways-ish, right? So then they started to hike rates a little. It kind of all got to the point where the S&P, I think, has like corrected like 15%. So yeah, sure, some is priced in, and then the question is there's going to be more issues down the line. I think that a full iron fist rotation of the easy conditions into tight conditions is going to erase at least a COVID liquidity wave. And that puts us back at like 2,800 to 3,000 for the S&P 500. I'll probably dive into that in the price target series, where that number comes from. And then the other things that we have, those debt cycles. If you look at the last, 600 years, we've been basically repeating the whole process of getting rid of debt into debt creation, into massive blow of top debt environments on average every 19 years. And the last time we kind of blew up the previous system is in 1929. So that is, in fact, 90 years ago. If a full inflation adjusted market crash happens, it could happen. It's going to happen at some point. If it were to happen from where we are now, that puts the S&P support, inflation adjusted, to mark the end of the debt cycle at around 1,400. No, it sounds silly and it sounds like very cheap. It could be that we're gonna continue for a couple of years, that we deflate whatever is going on right now, deflate the COVID liquidity wave, and then just add like another wave of QE and lower rates, and keep on going until things break. But if it were to happen from where we are right now, with the current kind of like pile of money created, 1,400 would be the target. And obviously that assumes a worst case 1929 capitulation doom porn scenario, which I don't want to scare you with, but it's in the back of my mind that it's possible. I'm not betting on it to happen, but I will be careful that it's a possibility. And if it happens, it won't happen in a few months anyways. Forward guidance and action will determine of what is to come. Yeah, really, Jack? Yeah, really. And then, I think we need to pay attention to inflation caused by supply restraints that cannot be solved by QE. As I said, they cannot conjure supply. And that means that if the geopolitical situation stays the same, if the Fed is committed to price stability, markets and central banks themselves, I don't know, maybe underestimating forward guidance, right? I mean, central banks are saying they're going to try and make a soft landing, but if they're really going to be pulling through with deflating a bunch of shit, I mean, Powell knew back in 2012 that it's, I mean, incredibly hard to create a soft landing. I don't think it's possible. So we can look at market expectations, for example, and you can use these tickers yourself, but we have the ZQ ticker, which is forward Fed futures, Fed funds futures, and so ZQ is, let's see, I always get confused, but Q is September. So you got, see, like ZQ U, ZQ H. H is March. So you got F, G, H, J, K, M, N, Q, U, V, X, Z, and they represent January all the way to December. So you can, let me show you. ZQ, can click this open, and then you can look at the various forward expected Fed funds. Man, I've been talking for 52 minutes and my throat fucking hurts. So I'm gonna take a sip. Coffee. All right. So I don't know. For example, let's look at what the market expects in September 2022. It says 97.91 here, and the way to calculate this is 100 minus R, and R is this number here. So essentially, what we got to do is 100 minus that. So market expects, is trading these futures, is hatching itself for the expectation of a Fed funds rate of almost 2.1% in September. I think there's no meeting in August. So basically, market expects 1.75%, so 175 basis points between today, and September. And then you can look at April. This is April 2023. Let's see. Yeah. So September, it went up. September 2023 market is pricing in 3.4%. So I think that alone is going to push, if that is, if the market is correct about that, it's going to push the 10-year yield above 4%. And, maybe this is, maybe the market has too much fear and they're making the wrong assumption here, and it's going to be lower, but it could also be higher. And everything that we talked about is influencing what the market is going to expect and what the Fed is going to have to do. Like, for example, the Fed raising rates to 3% next year. If inflation stays at 8%, that's just gonna not be enough, right? If that makes sense. I got a PDF here. I'm not going to talk about that. I'm not going to talk about this. So boop, 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 boop. Yeah, so I mean, just try and monitor these forward expectations. Markets often tell a good story on consensus, and you know, the Fed, and this is interesting to note. The Fed sometimes just say things or not like on purpose says things, or doesn't say things on purpose, just in attempt to influence pricing without the need to intervene. Sometimes they say A and do B, especially if markets actually already made A happen, right? And the other thing that sometimes happens is that they just keep the market guessing. And if if there's at times, if the goal is to lower liquidity and participation, volatility and uncertainty does help in reaching that goal. So, Fed is sometimes a little bit two-faced, and sometimes they say things because they want to be honest. Sometimes they say things just to keep people guessing or put them on the wrong foot in hopes that they can somehow influence how the market is pricing things. So yeah, I think, and that's an entire different topic, but what influences central bank policy decisions? I think there's a lot more things to this, but employment rate, savings rate, consumer spending, inflation of consumer and production costs, supply flow of energy goods. And if you think about energy, energy is required throughout the whole chain of production. Wheat, for example, doesn't have to go up in price if the supply is steady, but if gas costs go up, that's going to increase fertilizer costs. Fertilizer costs being increased is going to increase the cost of wheat, if that makes sense. Obviously, what happens across border policies. We talked about that. And I think, a very important thing for them to look at is where to push asset prices to, house prices to reduce the wealth effect. I think we're almost at the end. It's an hour, so I'm going to try and finish this. So I don't know what's going to happen next. Really, I don't know. But as it's, in my interpretation, there's just a lot of risk to the downside. If you take the analogy that a tightening market is as if you have a little swimming pool, and there's all kinds of boats and ducks floating around in that swimming pool, and then you start using a bucket to withdraw water / liquidity from the pool. On average, everything's going to be at a lower level eventually. And if you take the hose and start adding water / liquidity, everything's going to be higher. So markets from here on are tough. They're not accommodative, at least not in the US. And they're draining liquidity, and that's just not going to make it an easy market to trade. Fed injected liquidity goes negative because first it was positive, they were buying assets, now they're going to reduce assets. And the other thing, that might start happening at some point is that real yields, so basically the rates you get, the yield you get minus inflation, actually goes positive, which is going to draw a lot of money into back into fixed income instruments, which is a market they completely blew, popped the bubble on, and that's kind of reverse flows that we've seen over decades, where money has flown to stocks, hard assets like real estates, metals, Bitcoin, and eventually that will result in places of the economy in reduced inflation. So, assuming that demand drops or supply increases, or at minimum stays stable, and if that's not the case, there's more trouble ahead, because inflation will not be going down. And then everyone is asking the big question: what does that mean for Bitcoin? Can it decouple? I think anything is possible, but to me, considering the much higher participation of retail and institutions, and if we slide into an economic depression, you're gonna have all markets are gonna get hit, and things reset, and then things burn, and then you have ashes, and those rising out of those ashes the fastest, recovering the fastest, are the assets you want to own, right? Ones that either went a lot lower, so had high beta, or the ones that went down a lot less than the rest of the market, and then also show the willingness to recover faster. That's kind of where you want to go when there's an economic depression hitting and markets crash. I'm not saying that it's going to happen, but I'm sincerely thinking about the possibility of that happening. And the thing that people ask is, could we see a traditional finance crash, and people exiting traditional finance instruments, fleeing to Bitcoin? And obviously, yes, that could happen. The US dollar is one of the most liquid markets, and really should become a vacuum, sucking up everything when there's a major crash. So unless there's like a worldwide conspiracy almost to start buying Bitcoin when there's like a traditional finance mega exit, it's going to be very hard. Like, nobody with a sane investment approach will scale in right here, at least, if they don't have expectations of retail flow that can and will buy, when they start to distribute vertically. And Bitcoin certainly falls into the category of wealth effect producing assets, right? So I think the conclusion, and I hope everything I said makes sense. I probably butchered a few things here and there, and then obviously I probably repeated a lot of things a lot of times. But bottom line is, don't fight the Fed. I think that's just important. You have to realize, or you have to recognize, moments in the market when it's easy, and moment in the markets when it's hard. And people say, like, if you cannot make money when times are hard, you're a bad trader. Well, I think that's just utter bullshit. I think that great traders recognize when the market is easy and get the fuck out when the market is not easy. So until I see market is easy for some reason, which I'm not seeing right now, I'm just assuming to get the fuck out. And if for some reason we get a catalyst or something changes, obviously I will be willing to take risk. But the entire environment just doesn't signal it. And I think some of the greatest traders in history, since the Fed exists, actually, just say, don't fight the Fed. So I hope that was thought triggering. I hope that was useful. And let me know if I butchered anything. Let me know if you have any questions. I know it's a long thing to listen to. And, if anything was unclear, then I'm, just let me know, and maybe I can actually update specific areas and go into more depth. I hope you enjoyed yourself listening to my ramblings. I hope you take a look at PrimeXBT, our lovely sponsor. Thanks again for sponsoring PrimeXBT. Just, if you're trading, consider signing up, get the deposit bonus. It really helps me and PrimeXBT. And I hope that this was useful to you. All right. Take care and see you next time.